The Federal Reserve raising interest rates 1/4 point to a new range of 1.75 to 2%. The Fed forecasting further rate hikes or gradual increases ahead in the target range for the funds rate, saying this is consistent with its goals of a sustained expansion of the economy, a strong labor market, and inflation near its 2% target. The Fed also, the consensus Fed forecast now looking for 4 rate hikes this year. That is +1 compared to the prior forecast in March. Here's the new rate hike structure or consensus for rate hikes in the years ahead. 2018 is now 2.375. That's compared to 2.1, so there's that extra quarter point. That extra quarter point is picked up for 2019 to 3.125, 2020 3.375. The long run remains the same of 2.9, but if you look at that structure, what you see there is that the Fed now sees itself going above the long run rate next year, so a little bit faster to being above neutral. The Fed upgrading the economic outlook. I'll get to that in a second. I want to tell you the Fed removed a line saying that it is likely to remain for some time below the levels that are expected to prevail in the longer run. That's been there for a very long time. It was signaling an easier Fed in the years ahead. That's gone now. It's still calling its policy accommodative at this point. It means they intend to be at neutral or even go above it pretty soon. Here's some of the upgrade to the economic outlook in the language. It said the labor market continued to strengthen. That's the same, but it now says economic activity is rising at a solid rate compared to a moderate rate. Job gains, it says, have been strong. The unemployment rate, it said, has declined instead of stayed low. Household spending, it says, now has picked up. A little bit now on the forecast more from unemployment, 0.2 lower for this year to 3.6%, 1/10 lower for each of the next 2 years to 3.5%, and the long run estimate remains 4.5. So you see the Fed is okay being or is forecasting being a percentage point below its long run unemployment rate. Very quickly, not much more inflation, 0.2 more on PCE inflation. GDP up a bit for this year to 2.8, but heading down to 2.4 next year. 2% in 2020, back to the long-run rate of 1.8%. So a lot of news going on here. And as I said in the 1 o'clock hour, most of it tilting at least a bit hawkish, but not tremendously so, I'd say, Sarah.
Yeah, and you see that, Steve, in the dollar reaction, ticking higher in yields, which are ticking higher, especially the 10-year yield. Steve, would you say that the biggest news, the biggest headline in terms of changes for the Fed outlook is that they're now projecting 4 rate hikes this year versus 3?
I think that's pretty big. I think a chunk of the market was there. If you remember, our average from the CNBC Fed survey was 3.5, which told you that half of the folks were at 4 and the other half were at 3. So I don't think it's a huge surprise for the market. As I said earlier before the decision, I think there's a whole bunch of things that create a modest hawkish tilt to this that says, you know what, we're doing a bit more and we may do a bit more in the months or year ahead. But a lot of that depends on the data. Notice that their inflation forecast is pretty modest. They added 0.2. They're going to be at 2.1 for 2018, 2.1 for 19 and 20. So they don't see inflation getting out of control. I think that's the controlling factor to where the Federal Reserve goes from here. They do have to respond to the higher growth rates they see and the lower unemployment rate. I think they're doing that by adding that quarter, and then we'll wait and see.
And what was that language that they took out? In other words, that the trajectory of rates would be below what would be historically expectable?
Yeah.
That sounded important.
If I can count on the guy to ask the most complicated question, it's always Tyler. This language that was in there. It's sort of vestigial language, I think is the best way to put it. The language reads: the federal funds rate is likely to remain for some time below levels that are expected to prevail in the longer run. That was a way that I think Bernanke invented to tell the market, you guys, listen, chill out. We are going to be low for a long time to come. Well, that's no longer the case. And I want to make one other point here. As I had indicated, I thought Powell was going to move to simplify this statement. He did. It is down to 1 page now, and I think just 300-something words. And I counted at one point statements that got up to plus 700 words. There were all kinds of stuff going on. There was stuff put in there to mollify hawks, stuff put in there to mollify doves. All that's gone. I think this is part of who Powell is. You remember the last press conference, guys. He took as many questions in a shorter period of time, shorter answers, and nobody felt like they were shortchanged on information. So I think this is the new Powell era of simplicity, and I hope still transparency. I think there's still transparency in this. You have to maybe go over the words a little more carefully because he's using fewer of them, and he's taken a bunch out, and that's the one he took out there, Tyler.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.